So let's start with funding sources and capital structures. Now, in order to start there, we need to understand what a concept called the mining life cycle. So, a lot of you in the meeting have had extensive experience in the actual mining sector itself. So, you'll be familiar with most of these phases. Basically, if you look at this graph, it shows many things on the same graph. Okay, so if you look at your vertical axis, and if you look at the gray bars that are going downwards, that is your capital expenditure, and it's illustrated on the right-hand axis as millions of dollars spent in capex. You also have similarly a solid gray line that is the cumulative net cash flow position of the mine over its life. And then you also have, or let's say, net cash flow per period. And then on the left-hand side of the y-axis, you have that orange area, which just shows your production. Okay, it shows your ramp up, steady state, and then your winding down of operations. So what you can see there is in the beginning years, you are heavily investing in the development of your feasibility studies. Oftentimes, what happens is these mining companies would partner with an already established major. So, one of the big names are Rio Tinto and Anglo, and that Anglo operation would then, on in partnership with these junior mining consortia, would then fund the exploration of, let's say, an adjacent ore body, where they believe that there is a prospect to um, develop a mine that's in a certain area, but they want to do it on a non-recourse basis. So they don't want those new operations to interfere with their existing operations. So maybe they do it on a JV basis. So they take a new mining partner and they say, okay, we're going to do this on a JV basis. We're going to contribute equity into developing this new mine, and we will fund your exploration studies. Okay, so that's what you'd see at the early phases. So in the early phases, that's what would happen. Stage one, this is your exploration. So it would be nice if you had a major backing you, but they will take their fair pound of flesh. So they will take a significant ownership because at this stage, things are very unknown, untested, and risky. So that's stage one, mineral exploration. After stage one, you move to stage two, project evaluation and fundraising. So this is where you start with a pre-feasibility study. So your pre-feasibility study is where you haven't really done sufficient drilling. So you can drill an ore body, maybe you drill a core there, and a core is just basically you drill into the ground and then you extract what the stone looks like, and you see where that stone contains the ore that you want to mine for your mine. So depending on how much drilling you do, if your drill holes are very widely spaced, you actually don't know what happens between this drill hole and this drill hole. So you could have an ore body that's very nicely uniform, and that's very good because it provides a certain amount of stability for the mine. You know what to expect. But how are you going to discover that if your drill holes are quite a large distance apart? So in your early studies, obviously, the more you drill, the more expensive it gets. So you might not have that much confidence in the early phases of your development studies because you haven't drilled enough cores. Now, as you increase the confidence of your ore body, you do so by drilling more and more holes such that you've got a clearer picture of how your ore body actually behaves. Okay. Not only that, but you also get some professionals in to do costing and cost estimates, some preliminary ideas of should you mine this ore body using a just a truck and shovel, just an open pit mining method, or should you go underground? So you get the engineers in, and you also get the financial professionals in to do some cost estimates for you, and then you come to a conclusion as to, given the mining method, given the ore body, and given the likely costs, can we make this project work? Once you get to that level, then you are at definitive feasibility study level. And combining all three of those factors, you can then go from what are called resources, where, for example, we know the gold is there, but we don't know if we can mine it economically. Okay, and we don't have that much confidence on the ore body because we've only drilled here and we've only drilled here. You drill more and more and more and more and more. You do the costing and you come up with a plan of how you mine the ore body. And then you end up with what are called reserves. Okay. So once you get to that point, then you've got a definitive feasibility study. Now, if you can get a banking consortium to buy into that study and say, okay, we believe in your project too, your project is bankable. Then you go from having a definitive feasibility study to a bankable feasibility study. It's actually the same amount of technical work, but it's just that now you've got a banking consortium that'll back you, so now it's bankable. Okay. So that happens at stage two. Typically, what would happen as well is before these mining consortia approach the banks, they will approach the equity markets as well. And they will have that first slug of equity just to get their feasibility study to definitive feasibility study status. You want to get to that status before you approach the banks because banks won't even look at anything that's pre-definitive feasibility stage. It's just too risky, and it's not within a bank's mandate because you're providing a base where widows and pensioners deposit their funds. So you can't be too reckless with those funds when you're on lending to your investment banking division. So banks have certain mandates and certain risk thresholds that they probably won't play in that space. But as we'll see a bit later, maybe your royalty and your streaming companies will play in stage one. But as I mentioned before, they will take their fair pound of flesh. Okay, so quite richly priced and but high risk as well. Moving on to stage three. So now you guys get your credit approval, and this mine has, under your credit approval, you say that the mine has to raise a certain amount of equity to go hand in hand with the debt funding. Okay, so unless there's a strong sponsor, now what do we mean by a sponsor? So remember earlier I said that typically what would happen is you'd get an Anglo or you'd get a major, and that major would want to develop a new ore body, but they'd want to do it on a non-recourse basis. So let's separate my existing operations with this new one. We don't know whether it will fail or whether it will succeed. So I want it to be completely ring-fenced. So in that case, the banks can negotiate with a major and say to the major, okay, we like you. You've got a very big balance sheet. Can you provide us with some form of assurance or some form of guarantee such that we know that the project is supposed to cost $1 billion? But if there are cost overruns or if there are timing overruns, if things don't go according to plan, can we then look to you to provide support such that we know that the project will be completed? Okay, even if it's completed 6 months, a year, 2 years, beyond what we thought, can we rely on you to either complete the project or in the event that the project is not completed, let's say there's a 2-year delay, we have a certain debt facility that we've provided that only allows for 1 year or 1.5 year interest and capital grace. Can we then call upon you to pay us our interest and capital while we're waiting for this project to actually generate cash? Okay, so that form of support is called, it can come in the form of a guarantee, but basically it can come in the form of something as light as just an undertaking. Now, there's no legal obligation, binding legal obligation on an undertaking. All of this happens during stage three. You want all of this implicit support to be put in place. And you also want the company would have had to have raised the equity that your credit committee said. Yeah, your credit committee said, we'll give them the $1 billion, but they have to come up with $1 billion in equity so that it's about a 50-50 leverage, 50-50 debt. It's not a debt equity ratio, it's a leverage ratio, but 50-50 equity and 50% debt. Okay. And now that they've raised that cash, you begin to spend this capital expenditure. So this assumes a 3-year capital expenditure program. And After the first year, the mine will start producing a little bit and they'll start to ramp up. So this is where your financial modeling becomes a bit fun, in that you've got a cash flow profile and a capital expenditure profile for the mine. And your job as a financial modeler is to try and put in place a debt package that caters for this ramp up and this steady state, caters potentially for the event where things don't end up panning out as planned. So that's where you need to run your stress tests. And also, um, successfully amortizes the debt. So you strike a nice balance between solving the client's problem, but also doing it in such a way that does not prevent too big a risk to the bank, which is outside of the mandate of debt. So we will also touch on different funding structures where you can have senior debt, which should be the lowest risk funding that you can put into a company. Um, and then you would have your mezzanine debt. And the only difference between them is just the risk and reward trade-off. We'll cover that later. Okay. So then you have your steady state, just construction and ramp up. You have stage 4, which is your steady state production. So this is where typically you will have some project financing put in place. And what I've typically seen is the minute the mine gets to completion test, meaning that they've demonstrated an adequate track record, which was previously agreed to between the banks and the mining consortium, that the sponsor or the client. Let's just use all of those terms interchangeably. Sponsor, the mining company, the client. Okay, so we are the bank and they are the client. So once the client has passed a completion test, typically the first thing that they do is they'd want to refinance the project finance debt because it's expensive, it's onerous. Project finance facilities, you need to do a site visit every 6 months. They need to provide technical reports every 3 months, production updates monthly. And all of this places a strain on their administrative capabilities instead of them being free to focus on running their operations, which are very complex. Um, and they have their own problems. Now they have to hire somebody full time just to do production reports for the banks, just to coordinate site visits. And whereas they could take those resources, maybe 2 or 3 people that are dedicated to just serving the banks, they could take those people and maybe redeploy those people in the organization to maybe open up an adjacent ore body, or maybe improve the marketing side of how they sell their finished goods into the open market. So the client would see it, man, this project financing facility, thank you, you got me where I needed to go, but I can't go on like this for the next 2 years. Let me refinance. I still need the debt in my capital structure, okay, for various reasons. Um, Shareholders like a certain amount of debt in a business because the more gearing you have in a business, generally, and the corp fund guys are experts in this. Generally speaking, the more leverage you have in an organization, the better the returns are to shareholders. Why? Because you're taking cheap money in the form of debt, and the equity holders have to stump up less money on their side. So you're taking cheap money and you're still generating the same profit margin but using cheap money. So the actual expensive money that you as an equity holder put in, you're using OPM, other people's money, okay, to generate you a certain return on investment. And the less of that money that you have to put in yourself, bear in mind that the debt providers don't see any profit upside, but you're going to see that upside, and you're using as much OPM as possible, as much other people's money as possible. So the higher the leverage of a company, generally speaking, um, your rands as an equity holder go a lot further because you're putting in less rands, but you get the same return, and you pay the banks or the debt team, you pay them a lower rate of return than the return on equity if everything goes well. So what you'll see at this point in time is the companies would still want to keep a certain amount of debt in their capital structure just to maintain that philosophy that they want to be maximizing the return to shareholders, keep their shareholders happy. But at this stage, you'll see that the financial modeling part is mainly restricted to perhaps downside scenarios. The clients don't need you to sculpt and structure amortization profiles because their cash flows are quite steady at this point in time. Maybe what they just need is some RCFs and some working capital facilities. Okay. They might have some amort there, but truth be told, if they had their way, they would just have revolving credit facilities if they had their way. Maybe it's also a good time for them to raise bonds because bonds give them this nice flat capital structure where they don't have to pay contractual amortization and they just roll the bonds continually until they reach stage 5, where the ore body begins to come to the end of its life. Okay, so closure and rehabilitation. And during stage 2, 3, 4. In fact, I think stage 1 as well. You have to also make provision for rehabilitation of your mine site. So you have to have those facilities put in place quite early, your environmental guarantees. And what you would do as a mining company is typically they would put money aside and they would actually cash collateralize those guarantees so that by the time they reach closure and rehabilitation, the banks or the insurance companies provide a guarantee or provide a promise that if the mine shuts down, there's enough money we will pay in order to put this thing on care and maintenance or rehabilitate the land. But in the process of mining, you'd want to cash collateralize that such that it's the client's money at the end of the day that actually does pay for the closure and rehabilitation. And in order to do that, during stage 4, the company would have to continuously put money aside into an account that accumulates up to the amount of the closure and the rehabilitation. And that would sit with a bank, and then it's fully cash collateralized at a certain point in time. And they would then close the mine site using that money. Okay. So the purpose of showing this is at each stage of a mine's life, the mine would have a different capital structure, a different optimal capital structure. And we will see what the optimal capital structure is at each phase of a mine's life.